There is a number that should not exist right now. While missiles were being tracked over the Persian Gulf, while tanker insurance rates were spiking to levels not seen since the early days of the Ukraine war, while every energy desk on Wall Street was running emergency scenario models, gold fell. Not marginally, not within the noise of a normal trading session. Gold recorded one of its sharpest multi-day declines in recent memory during one of the most acute geopolitical escalations of the decade. Let that sit for a moment. The asset that every retail portfolio guide, every financial planning article, every protect yourself from crisis seminar positions as the ultimate hedge against exactly this kind of instability, the asset that is supposed to rise when the world becomes more dangerous, collapsed at the precise moment the world became more dangerous. If you cannot explain that, you are not looking at the right problem. Most investors right now are watching oil prices. They are reading about conflicts in the Middle East. They are calculating what higher gas prices mean for their commute or their business. That is the wrong level of analysis. That is looking at the surface while the real structural damage is happening underneath, in the plumbing of global monetary policy, in the balance sheets of sovereign wealth funds, and inside financial products that millions of retail investors hold without understanding what those products actually do when markets move against them. This is not a video about whether oil will hit $100 or $120 or $150 per barrel. Those are outcomes. This is about the mechanism. The sequence of events that begins the moment a strategic energy corridor comes under credible threat and ends with a specific, mathematically predictable redistribution of wealth, away from investors who don't understand the chain toward the ones who do. The history of every major energy disruption shows the same pattern, not the same prices, not the same politics, the same chain of cause and effect. And right now, that chain is being activated again in a form that is particularly dangerous because of one variable that did not exist in previous cycles: a central bank that is already trapped before the shock arrives. The Federal Reserve entered this moment in one of the most constrained positions of its modern history, not because of incompetence, because of arithmetic. Inflation that was supposed to be transitory proved structural. Rate hikes that were supposed to cool the economy produced a labor market that refused to break, and a services sector that kept expanding. And just when the market had priced in a dovish pivot, just when the dominant narrative for 2026 had been settled around rate cuts, a new wave of inflationary pressure is building from the one source the Fed cannot suppress by adjusting interest rates: the physical supply of energy. You cannot raise interest rates to produce more oil. You cannot quantitative ease your way to more barrels per day. When the disruption is on the supply side of a commodity that is embedded in the cost structure of virtually every product and every service in the global economy, monetary policy becomes a spectator. The central bank watches. It cannot act to solve the problem. It can only choose which crisis it wants to make worse. That is the trap. And the trap has two jaws. If the Fed cuts rates while energy-driven inflation is re-accelerating, it loses credibility. Bond markets reprice. Long-term yields explode. The very assets that were supposed to benefit from rate cuts, growth equities, rate-sensitive utilities, long-duration bonds, get destroyed not by higher short-term rates, but by an unanchored long end of the yield curve. The 1970s did not destroy portfolios in one dramatic crash. It destroyed them in a prolonged, grinding repricing that took years and left most investors confused about why their diversified portfolio kept losing purchasing power even in years when the stock market showed nominal gains. If the Fed holds or raises rates while the economy softens under the weight of expensive energy, it triggers a different kind of damage. Corporate earnings compress. Consumer spending contracts. Credit spreads widen. The recessionary pressure that was supposed to be avoided by a soft landing materializes, but now it arrives alongside inflation, which is the worst possible combination for a portfolio manager trying to find any asset that works. There is no clean exit from this configuration. That is not an opinion. That is the geometry of the situation. And the investor, who is sitting on a portfolio built for a world where the Fed was going to cut rates by 150 basis points in 2026, where inflation was going to continue drifting toward the 2% target, where growth equities were going to resume their upward trajectory, that investor is holding a portfolio designed for a world that no longer exists. The question is not whether you believe that. The question is whether the arithmetic believes it. And arithmetic does not care about your belief system. What makes this moment structurally different from standard geopolitical risk events is the convergence. A disrupted energy supply chain alone would be manageable, expensive, but manageable. A central bank in a bind alone would be concerning, but navigable. The combination, arriving simultaneously, creates a feedback loop that is not linear. Each element makes the other worse. Higher oil prices make the inflation problem harder to solve. A harder inflation problem makes the Fed less able to support growth. Less growth support increases credit risk. Higher credit risk increases dollar demand. A stronger dollar puts pressure on commodities priced in dollars, including oil, but also compresses the earnings of multinationals just as their cost structures are being inflated by energy prices. The chain does not stop. It does not have a natural equilibrium point in the short term. It runs until something breaks. And historically, what breaks first is not the banks, not the corporations, not the commodities. What breaks first is the retail investor. What you need is the framework, not the headlines, not the hot takes, not the social media consensus that coalesces around whatever the most recent data point happened to be. The framework, the mechanism, the sequence that has repeated itself with enough historical regularity that calling it a pattern is not speculation. It is pattern recognition based on multiple decades of precedent. That is what the rest of this analysis is going to give you. Not a stock tip, not a specific trade. A map of the terrain, built from the causal logic of how energy disruptions become monetary crises, become portfolio events. 3. Min-Mark, CTA. If this kind of analysis is useful to you, the mechanism behind the headline, not just the headline itself, subscribing to this channel is the logical next step. This is the type of content published here consistently. Now, back to the chain. The first thing you need to understand is geography, not geopolitics. Geography. There is a passage of water approximately 21 miles wide at its narrowest point. 21 miles. The English Channel, by comparison, is 21 miles wide at its own narrowest crossing. We are talking about a strip of ocean that you could theoretically see across on a clear day. And through that strip of ocean flows, depending on the estimate you use, somewhere between 15 and 20% of all the oil traded globally by sea. This is the Strait of Hormuz. And it is not just an energy choke point, it is a mathematical lever on the cost structure of the global economy. When that corridor becomes credibly threatened, not necessarily closed, not necessarily physically blocked, but threatened enough that the insurance markets begin to price in the probability of an incident, the mechanism activates. The cost of insuring a tanker passage increases. Shipping companies begin rerouting or delaying. Oil companies begin drawing down inventories faster than they replenish them. And the price of crude does not wait for an actual disruption to happen. The price of crude responds to the expectation of reduced supply immediately before a single barrel is actually interrupted. That is how commodity markets work. They price the future, not the present. And when the future contains a credible scenario where 20% of global seaborne oil supply is at risk, the market does not calculate the exact probability and apply a precise adjustment. It overshoots. It always overshoots. Because the people running energy trading desks are not paid to be right about the average outcome. They are paid to not be caught flat-footed when the worst outcome materializes. The overshoot is not irrational. The overshoot is survival logic applied to the energy market, and that is where the cascade begins. In 1979, when the Iranian Revolution removed one of the world's largest oil producers from the global supply chain, the price of crude oil did not drift upward. It roughly doubled within months, from approximately $15 per barrel to over 30. And then, as the combination of supply disruption and the subsequent Iran-Iraq war compressed output further, the price kept climbing until it reached levels that would not be seen again for more than 20 years. The inflation that followed was not the manageable, predictable kind that central banks are designed to absorb. It was structural inflation embedded into the cost of every product manufactured, transported, refrigerated, or packaged in the industrialized world, because oil is not just gasoline. Oil is feedstock for plastics. Oil is the energy source for fertilizer production. Oil is embedded in pharmaceuticals, in packaging, in synthetic textiles, in industrial lubricants. When oil doubles, it does not mean you pay twice as much at the pump. It means that the cost of production for a broad range of goods across the economy shifts upward simultaneously, and it shifts upward before those costs show up in official inflation data because the transmission takes months. In 1990, when Iraq's invasion of Kuwait triggered a different kind of supply disruption, crude oil moved from approximately $17 per barrel to over 40 within weeks. It subsequently retreated as the military resolution clarified supply restoration timelines, but the months of uncertainty between the initial disruption and the resolution were sufficient to leave a mark on economic data that persisted long after oil prices had normalized. In 2022, when Russia's invasion of Ukraine removed a different type of energy supplier from the market, this time natural gas, with secondary effects on oil, European energy prices hit levels that forced industrial shutdowns. German chemical manufacturers, operating on the assumption that cheap Russian gas would remain available indefinitely, faced input costs that made production economically indefensible. Some facilities closed permanently. The pattern across these three events is not the specific commodity or the specific geopolitical actor. The pattern is the structural consequence of a supply shock in a commodity that has no short-term substitute. The world cannot quickly replace oil with something else. The infrastructure does not exist. The capital investment required would take a decade. In the short term, the world adjusts to expensive oil by consuming less of it, and that consumption reduction is called a recession. This is the first mechanism. Supply disruption, price spike, embedded inflation across the cost structure of the economy. Central bank faces an impossible choice. The central bank's impossible choice is the second mechanism, and it is the one most investors are not tracking. The Federal Reserve has two mandates: price stability and maximum employment. When inflation is high and the economy is strong, those mandates point in the same direction: raise rates. When inflation is high and the economy is weakening, those mandates begin to conflict. Raising rates to suppress inflation accelerates the economic weakening. Cutting rates to support growth risks re-accelerating inflation. The central bank must choose which mandate to sacrifice, and either choice creates damage. But there is a third configuration that is worse than both. When the source of inflation is not demand, not too much money chasing too few goods, but supply, the Fed's tools become almost entirely ineffective against the root cause. Higher interest rates cannot produce more oil. They can reduce demand for oil by slowing economic activity, which eventually reduces price pressure, but the mechanism requires destroying growth to kill inflation. The cure is the disease administered in a different dosage. This is the configuration the market entered in late 2024 and has not fully exited. Inflation that was supply-side in origin, partially addressed by demand destruction, now faces a potential reignition from a new supply-side shock. And the Fed, which had been slowly working toward a more accommodative posture, is now looking at a scenario where cutting rates into a new inflationary wave is not a policy option. It is a policy catastrophe. The bond market understands this better than the equity market does. when expectations for rate cuts get repriced, when traders who had been pricing 4 cuts in 2026 begin moving to 2 cuts, then 1, then 0, the effect is not abstract. It is immediate and mechanical in specific asset categories. Growth equities, companies whose valuations are built on the discounted present value of earnings that will arrive years or decades in the future, are exquisitely sensitive to the discount rate applied to those future earnings. When the discount rate stays high, those future earnings are worth less today. The mathematical relationship is not approximate, it is precise. A 1 percentage point increase in the expected long-term rate applied to a company whose earnings are weighted heavily toward the future can reduce its theoretical present value by 15 to 25%, depending on the duration of that earnings stream. This is not a prediction. This is the formula that every institutional valuation model runs automatically. The retail investor who is holding a portfolio of high multiple technology companies or speculative growth stocks, anchored in the belief that rate cuts are coming and will reinflate those valuations, is not wrong about the direction of the mechanism. Rate cuts would reinflate those valuations. The problem is the premise. The rate cuts may not come, and if the energy shock deepens, the next move may not be a cut at all. This is where the third mechanism enters, the one that generated the anomaly described at the beginning of this analysis: the behavior of gold. Gold has a well-documented relationship with real interest rates. When real rates, the difference between nominal rates and inflation, are negative or very low, gold tends to perform well because the opportunity cost of holding a non-yielding asset is low. When real rates are positive and rising, gold tends to underperform because you are giving up meaningful yield by holding it. But there is a second layer to gold's behavior that the standard textbook treatment ignores, and that layer is institutional mechanics. Gold is held in enormous quantities by sovereign wealth funds, particularly in the Gulf region. The sovereign wealth funds of Gulf oil-producing states manage capital generated from oil revenues. When oil revenues are disrupted, or when those funds face fiscal pressure from their domestic governments that require capital repatriation, the liquid assets in those portfolios get liquidated first. And gold, being one of the most liquid assets in the world, is among the first to be sold. This creates a scenario that is deeply counterintuitive to the retail investor. A geopolitical event that disrupts oil supply and threatens Gulf state revenues creates simultaneous pressure for Gulf sovereign funds to sell gold, the very asset that every retail investor expects to buy in exactly this situation. The selling pressure is institutional and structural. It does not respond to the same logic that drives retail behavior. Add to this the second layer of institutional mechanics: leveraged ETF products. There are products available to retail investors that offer 2 times, 3 times, even 4 times the daily return of gold. These products are legally constructed, widely distributed, and fundamentally misunderstood by the majority of the people who hold them. When gold falls 2% in a single session, a 3 times leveraged product loses 6%. That 6% loss creates margin calls for investors who purchased on leverage. Those margin calls require selling immediately at market prices without regard for valuation or fundamentals. The selling drives the price of gold lower. Lower prices trigger additional margin calls on other leveraged holders. Additional margin calls create additional selling. The cascade compounds itself mechanically, not because of any change in the fundamental value of gold, but because of the mathematical structure of the products through which retail investors are exposed to it. This is not a theory. This is the documented mechanism behind sharp, rapid declines in assets that carry significant leveraged retail exposure. It has been observed in gold. It has been observed in oil futures. It has been observed in volatility products. The retail investor who does not understand the difference between owning an asset and owning a leveraged daily reset product linked to an asset is not just exposed to the underlying asset's risk. They are exposed to the amplified, mechanical, cascade risk built into the product structure. The result is destruction on two fronts simultaneously. The growth equities that were supposed to benefit from rate cuts fall because rate cuts are no longer coming. The gold position that was supposed to protect against the risk environment falls because institutional selling and leveraged product mechanics drive forced liquidation at the worst possible moment. The investor who was diversified between equities and gold discovers that in this specific configuration, diversification provided no protection. Both assets declined. The mechanism that was supposed to produce opposite movements produced correlated losses. This is not bad luck. This is a predictable structural outcome of the specific configuration that exists right now. The sectors that fare well in this configuration are not the obvious ones. They are not the ones that appear in standard defensive investing guides, because most of those guides were written for a different inflation regime, one where energy was cheap and rate sensitivity was the primary risk variable. Companies that operate infrastructure for energy transportation, pipelines, storage terminals, liquefied natural gas export facilities, collect revenue based on throughput volume, not on the price of the commodity flowing through their infrastructure. When oil prices move from $80 to $120 per barrel, these companies do not pay more for the oil. They charge more in absolute dollar terms for moving it because the commodity's higher value is indexed into the fee structure. The volume of energy that needs to move does not decline significantly when prices rise. The demand for energy in the short term is highly inelastic. You cannot stop heating your home because natural gas is expensive. You cannot ground your supply chain because jet fuel costs more. You pay. The entities that collect the fees from that inelastic demand are mathematically in a different position than the entities exposed to the commodity price directly. Companies that have genuine pricing power, the ability to pass through cost increases to their customers without losing volume, function differently in an inflationary environment than companies that must absorb cost increases because their customers have alternatives. The distinction matters more now than it has in the past decade, because the past decade was characterized by such low inflation that pricing power was not a meaningful differentiator. In this environment, it is the primary differentiator. On the other side of the ledger, airlines carry jet fuel as one of their largest cost inputs and cannot easily pass through a significant increase in that cost to ticket prices without destroying demand. Rate-sensitive utilities carry substantial debt and depend on the spread between their regulated return and their borrowing cost. When rates stay high longer than expected, that spread compresses. Consumer discretionary companies that operate on thin margins with significant transportation and input cost exposure face the kind of margin compression that cannot be modeled by simply extrapolating last quarter's numbers. The investor who holds a portfolio constructed for a low inflation, rate declining environment is not holding a portfolio appropriate for the current structural configuration. That portfolio was designed for a world with a specific set of assumptions. Those assumptions are being invalidated by the sequence of events currently in motion. Recognizing that invalidation is not pessimism, it is the beginning of rational response. The most dangerous financial position is not the one with the most risk. It is the one with invisible risk, risk that has been mislabeled as safety. The investor who knows they are taking a concentrated bet can manage that bet. They can size it, hedge it, monitor it, exit it. The investor who believes they are safely diversified while holding a portfolio that has structural exposure to a correlated failure mode has no system of alerts. They are not watching for warning signs because they do not know warning signs exist. The damage arrives before the adjustment is made. This is the renunciation that must happen before any productive repositioning is possible. The belief that gold is always a safe haven must be replaced with a more precise understanding. Gold performs as a safe haven under specific conditions, and those conditions include the expectation of real rate decline and the absence of institutional forced selling. When those conditions are not present, Gold is not a safe haven. It is a volatile commodity with complex institutional mechanics that can produce losses amplified by the product structure through which most retail investors access it. The belief that rate cuts are coming and will reinflate growth equity valuations must be replaced with a probabilistic assessment that accounts for the inflationary constraint on monetary policy. A portfolio that has concentrated its bets on the rate cut scenario cannot be considered balanced. It is a directional bet masquerading as a long-term investment posture. The belief that airlines, utilities, and consumer discretionary companies are defensive investments in a flight to safety scenario must be examined through the specific lens of the current inflation regime. Defensive in one regime is not defensive in another. The 1970s demonstrated with extraordinary precision that the entire category of assets considered safe by the conventional wisdom of the 1960s was not safe in an environment of sustained energy-driven inflation. The investors who learned that lesson early positioned themselves correctly for years. The ones who held on to the old definitions watched purchasing power erode while believing they were protected. The conditions that produced the last decade of investment results are not the conditions that exist right now. The actionable framework that emerges from understanding this mechanism has three components. First, an audit of current exposure. Before adding or removing anything, understand what you actually own and what assumptions are embedded in those positions. Not what the ticker says, what the underlying thesis is. If the thesis is rate cuts will reinflate valuations, that thesis now requires explicit validation. If the thesis is gold will protect me in a crisis, that thesis requires an examination of which type of crisis and whether the current configuration qualifies. You cannot manage exposure you have not identified. Second, structural adjustment in the direction of what the mechanism rewards. The mechanism rewards entities that collect fees on the movement of energy regardless of price. It rewards companies with genuine pricing power in industries with high switching costs. It rewards cash-generating businesses with low capital intensity. It penalizes companies whose valuations require significant rate relief. It penalizes businesses dominated by energy and transportation costs. It penalizes leveraged exposure to assets carrying institutional forced selling risk. The adjustment does not need to be total or immediate. The mechanism does not resolve overnight. The investor who makes thoughtful, incremental adjustments over several months is not late. The investor who makes no adjustments while expecting conditions to revert is taking a specific bet that the conditions that broke the old framework are temporary. That bet has a poor historical track record. Third, recognize the opportunity embedded in the dislocation. The redistribution of wealth that occurs during structural change is not random. It flows toward investors who understand the mechanism and away from those who are positioned for a world the mechanism has already changed. That is not a prediction. That is the documented pattern of every major economic transition of the past century. The chain is already in motion. The Fed is already trapped. The institutional mechanics driving gold's counterintuitive behavior are already visible in the price action. The question is not whether the chain is real. The question is which side of it your portfolio is on. 3 questions for the comments. If the Fed is genuinely trapped between inflation and recession, which outcome do you think they ultimately allow to materialize, and why? Is there an asset in your current portfolio that you now realize was built on assumptions this analysis directly challenges? What is the equivalent 1960s playbook that most investors are still running today without realizing it? The comments are the most underused analytical tool on this platform. Use them.